Welcome to today's Explainer. Growing up, I think our mothers all basically told us the exact same thing over and over again. Just buy gold, and let's be honest, what did we do? We completely rolled our eyes. We chased after all the cooler investments, right? We got totally swept up in mutual funds, tech stocks, crypto, thinking, man, physical metals are just way too boring for a modern portfolio. Well, grab a seat because today we are going to look at some hard, cold data that literally proves Mom was a financial genius all along.
Okay, let's dive into this. Here is the absolute ultimate reality check for anyone who still thinks gold is just for traditional jewelry. So, over the last 10 years, India's top stock market index, the Nifty 50, gave a really impressive 13.5% return. Not bad at all. But look right next to it. Boring old gold? It delivered over 15% returns. And no, this isn't just some random fluke over a single decade. The data actually shows that gold has consistently beaten the Nifty 50 over 5, 10, 15, and even 20-year periods. It's wild. It has basically been hiding in plain sight as a vastly superior asset. So, now that we know Mom was right, we've got a packed agenda for today's Explainer. First, we'll unpack the Great Gold Rush. Second, why central banks are hoarding. Third, we'll look at the case for silver. Fourth, 5 ways to invest without getting ripped off. And finally, we'll build the ultimate 2025 strategy. Let's get right into it.
Section 1. The Great Gold Rush. Let's see exactly why prices are skyrocketing.
And this brilliantly illustrates the foundation of it all. If you look at an Indian rupee note, or honestly, historically, at currencies all around the world, you always see a promise. I promise to pay the bearer the sum of, right? For the longest time in human history, this promise literally meant that the piece of paper in your hand was backed by actual physical gold sitting in a vault somewhere. Now, we officially broke that link back in the 1970s, but psychologically, we never really let it go. I mean, if we rewind to the year 2000, gold was sitting around a pretty modest $270 an ounce. But today, it has completely shattered records, rocketing up past $2,700 and beyond to just astonishing new highs. Why? Because whenever modern fiat currencies start feeling unstable, or whenever there are geopolitical tensions or trade wars, humanity's collective instinct is to flock right back to the ultimate currency-agnostic asset, gold.
Which brings us to the massive elephant in the room. By September 2025, the United States national debt hit a staggering $35.7 trillion. To put that into perspective, it's just an unfathomable amount of money. And how do governments handle this kind of crippling debt? Simple, they print more currency. But here's the catch, and it's a big one. When you print more money to chase the exact same amount of goods, you get inflation. Basically, your money just loses its purchasing power. Gold, on the other hand, you can't just print it at will. Actually, scratch that, you literally can't print it at all. It has to be physically mined from the earth. This inherent scarcity makes it the perfect shield against endless money printing. And that is exactly what's driving demand through the roof.
Section 2. Central banks are hoarding. From retail fear to institutional reality. Now, what's really interesting about this is our very own Reserve Bank of India. The jump here is massive. Back in March 2020, the RBI held 650 metric tons of gold. Fast forward to March 2025, they have rapidly boosted their reserves to 880 metric tons. This aggressive accumulation makes India the 7th largest gold holder in the entire world. And it's definitely not just India doing this. China and other powerful financial institutions globally are scaling up their gold purchases by roughly 10x. They are quietly but aggressively stockpiling. Think about it. When central banks start buying like this, they're basically signaling a massive lack of trust in the stability of global currencies. And we should absolutely be paying close attention to what the smart money is doing.
Section 3. The case for silver. Gold's highly volatile but incredibly lucrative younger sibling. To really understand silver's potential, we need to look at a super important metric called the gold-to-silver ratio. This is simply the number of ounces of silver it takes to buy exactly 1 ounce of gold. Historically, over the last century or so, this average ratio sits at about 67 to 1. But today, in 2025, it's hovering around 92 to 1. Keep in mind the price explosion we've already seen, where silver jumped from roughly 40,500 rupees per kilogram in 2020 to an insane 134,000 rupees per kilogram today. It basically nearly tripled. Yet, even with that massive price jump over 5 years, a ratio this high historically signals severe economic instability. It also suggests a really massive pricing gap. It basically tells us either silver is still significantly underpriced right now, or gold is vastly overpriced.
But, silver has a secret weapon that gold just doesn't have. It is an absolute industrial powerhouse. A decade ago, industrial applications accounted for about 45% of silver's total demand. Today, that number has jumped to over 60%. We are talking about things like solar panels, electric vehicles, 5G telecom equipment, smartphones, medical devices, water purification, the whole shebang. This creates what economists call inelastic demand, meaning manufacturers can't just casually substitute silver for something else when the price goes up. They literally need it to build their products. This guaranteed industrial demand acts as a total rocket booster for silver's price. Moving on to Section 4, 5 Ways to Invest, a practical buyer's guide for 2025. Let's run a quick process of elimination here to figure out how to actually buy these metals without getting ripped off by hidden fees. First up, physical gold. Look, if you buy jewelry as an investment, you are immediately getting hit with a 3% GST plus heavy making charges. You're starting at a loss right out the gate. Plus, liquidity is pretty low, so cross physical jewelry off the list for purely financial investing. Digital gold. Sure, it's super easy to buy on apps, but the spread between the buying and selling price is huge, which just eats right into your profits. Then there's sovereign gold bonds, or SGBs. These used to be the absolute gold standard because they offered tax-free gains and a 2.5% interest rate. But guess what? The government actually had to pause the program. Why? Because gold prices surged so much, the government was literally bleeding money trying to pay out those massive 15% plus annualized returns to investors. Crazy, right? So by process of elimination, that leaves us with the clear winner, ETFs. Before we move strictly to ETFs, though, I do want to share a really brilliant financial hack for those of you who already own physical gold jewelry. While it's a terrible financial investment to buy new jewelry, your existing jewelry is incredible collateral. If you ever find yourself needing cash, do not take out a personal loan at 15 or 16% interest. And please don't sell your family gold. Instead, take out a gold loan. You can secure one at a much, much lower interest rate, usually around 10 to 12%. You just pay the interest, and eventually you get your physical asset right back. It is incredibly smart leverage.
Section 5, the ultimate 2025 strategy. So the crucial point is building your action plan. Based on everything we've unpacked today, it's crystal clear that these precious metals aren't just for doomsday preppers anymore. They are absolutely essential. Financial experts actually suggest allocating a healthy 10 to 20% of your entire portfolio into these safe haven metals, depending on your age and risk tolerance, of course. So, here is your definitive step-by-step action plan to execute this safely in 2025. Step 1. Completely avoid jewelry when your goal is pure financial return. We covered why. Step 2. Pick a gold or silver ETF. Exchange-traded funds like the Nippon India ETF or the SBI Gold Fund are the absolute champions right now. They have ultra-low expense ratios, usually around 1% or less, and they offer instant liquidity. You can buy and sell them just like regular stocks. It's so easy. And finally, step 3. Start a monthly SIP, a systematic investment plan. The metals market can be incredibly volatile, but by investing a set amount every single month, regardless of whether the price is up or down, you average out your costs and conquer that volatility over a 5, 10, or 20-year horizon. We've seen the massive returns, we've seen central banks aggressively hoarding, and we've decoded the absolute most cost-effective way to get involved. The macroeconomic writing is on the wall, guys, and the industrial demand for these metals is just completely unstoppable. So I want to leave you with this one thought to reflect on. Knowing what you know now from today's explainer, will you add gold to your portfolio today? Thanks so much for joining this explainer, and stay focused on your financial growth.